While investment objectives are usually tied to the investor's risk tolerance and life stage, setting financial goals of specific amounts of cash required in each period helps to ensure that targets are met. Common goals include paying off your student's loan, accumulating funds for retirement, or saving for your children's education. For each of these financial goals, you need to work out how much money you need and when you need the money. There are generally three basic objectives of investment, namely income, growth, and security. In the next slide, we'll study each of them in turn. Investors with income-oriented goals are more concerned about current income than capital appreciation. For those who are nearing retirement, this becomes an increasing need. Products that offer regular returns like fixed deposits, corporate and government bonds are commonly used. Portfolios of individuals seeking income above the market average carry higher risks and can be more volatile than the general market. As such, high-interest bonds and high-dividend stocks will be the main components. Investors with growth-oriented goals are the reverse and tend to take a longer-term view. They have a longer time horizon and target capital appreciation rather than short-term income. They must recognize and accept the risks inherent in investments of this type. Growth investments typically generate little or no current income. Some investments are more volatile than others, which can lead to substantial and rapid changes in gains or losses in the value of the account. Finally, investors with security-oriented goals are concerned with capital preservation and tend to place greater emphasis on diversifying their portfolio in order to reduce risk and at the same time maintain their purchasing power. They tend to go for investments that guarantee the principal invested, as well as returns. While no investment option is completely safe, near-safe products such as fixed deposits, savings accounts, government bonds, and very high-quality fixed income investments are preferred. People who incline towards this style are usually very risk-averse, very wealthy, or those in the estate distribution phase of their lives. For instance, if you are saving for a major but short-term financial goal, like paying college tuition, you might be less inclined to put your entire portfolio at risk. An investment horizon refers to the amount of time you have to invest so as to achieve your financial goals. A longer investment horizon allows you more time to ride out short-term price fluctuations on your investments. Furthermore, the longer the investment horizon you have, the more time you also have to grow your savings through compounding. Compounding is about earning interest upon interest, that is, the returns on previous returns. This means that earnings that you earn are reinvested and thereby increase the amount upon which more earnings are generated. So if you start early, your investments will be able to compound over a longer period of time. The earliest returns are reinvested for the longest time and therefore generate greater returns. Generally, the shorter the investment horizon you have, the lower the risk you can bear. If you cannot afford to lose money, you should only invest in less risky assets if you have a short investment horizon. This means that if you need your money in a short time, you cannot take chances with your capital. you should invest in assets that do not put your capital at risk during the period. So the lesson here is, start investing early, and that will help increase your chances of meeting your financial goals. Your risk-return profile and investment horizon depends on the life stage you are in. The accumulation phase. If you are early in your career and you would tend to have a small net worth relative to liabilities, such as car and house loans, your priorities are liquidity, home, and probably children's education. As you are young and have a very long investment horizon with a growing stream of income, you can undertake high-risk, high-return, capital gains-oriented investments, but only if you have the risk appetite to do so. In the savings phase, you are in your mid to late career stage. Your income exceeds expenses because your commitments are beginning to taper off. You start to accumulate in your investment portfolio. Your investment horizon is now shorter than before, but still relatively long. You can still continue to undertake high-return, capital gain-oriented investments while reducing the overall risk exposure involved. In the third phase, the pre-retirement phase, you are in your late career stage. At this point, there is greater emphasis on income needs and capital preservation, meaning that you probably need to supplement your income with investment income from low-risk income-generating ones, such as bonds or dividend-paying stocks. Your investment horizon is short, and your portfolio is typically shifted to significantly lower return and lower risk assets with larger dividend or interest payment components and relatively secured asset values. Even so, you may still wish to keep a portion of your assets in capital gain-oriented investments. In the retirement phase, your expenses exceed income because you are probably retired. Your investment horizon is now very short. You can still continue to undertake low-risk, income-generating oriented investments, but be mindful of hedging against inflation. Do consider that retirement planning should ideally start from the time you start your career.